Hey, thanks for tuning in. This is another live recording of Going Elliptic, where we're going to have some more interesting conversations with people who've been around in the industry for a long time. Might not be the most well-known names, but interesting conversations nonetheless. And there's a lot we can all learn and share. But as a reminder, this will not be investment advice from either us or our guests. It's purely educational content, and we hope you like it. If you do, always feel free to click like or subscribe to hear more of our content. So, Shanky, how are you doing?
Hey, Paul, doing well. How are you doing today?
Yeah, pretty good. Obviously, a lot of volatility in the weekend, and we just kind of covered that briefly on our charted session, looking at those charts and what happened with Bitcoin. And that might also come up in our conversation today as well. I think it's on everyone's minds.
Totally. Yeah, the craziness continues.
Yeah. So who's our guest for today? Do you want to do the intro?
Absolutely. Yeah. So we've got an amazing trader and a very interesting person as a guest today. As we have been trying to bring on a lot of crypto OGs, people who've been in this space for a long time, 8-10 years or so, which is really a lifetime in the world of crypto. And today's guest is also one of them who's really seen it through the years. He's also had a big impact early on because he created a trading bot that we'll talk about a little bit when we bring him on. That really was one of the first few out there that people used to trade crypto. So his name is Mike von Rossum. He's a well-known trader, and of course understands crypto very well through his journey over the last decade. So yeah, let's bring him on, Paul. Let's talk to him.
Hear more about it. Hey, Mike.
Hey, guys.
Hey, Mike.
Hey,
how are you
doing?
Me? Of course, it's
very
a pleasure.
Well, very well.
Yeah. So I think to kick things off, Mike, the best sort of starting point for us would be tell us a little bit about your personal journey. You've been around for a long time, a decade in crypto. How did it all start? What's the sort of origin story there, and then how did it kind of evolve? So maybe get us started there.
Sure. So actually, Gekko, you already brought it up a little bit. So that's actually for me basically the entry point. So this was a long time ago. It's almost a decade, not quite, but very close. This is when I was still in college, and I studied like some multimedia stuff, but there was some programming involved. So this is back when I didn't know much about programming, and I knew nothing about finance or trading or nothing like that. But I did get inspired by some books. Like at the time, you had the book Flash Boys from Michael Lewis. And those kind of works, and then there were also some other like there's some stuff on YouTube out about like high frequency trading and all that kind of stuff. I was really into that, but I didn't know anything about trading, finance, programming. So back then I slowly started my own way with Gekko. So from day one, Gekko was open source. And actually, recently, I went up to Bitcoin Talk. So Bitcoin Talk is the old forum where all the Bitcoin people used to hang out, like up until around 2014 or so, I think, 2015 maybe.
Yeah, there was a big hacker Bitcoin Talk, right? So everyone kind of exited after that.
Yeah, you're right, actually. Yeah. My email address still floats around, I think, in the in all kind of hack database dumps and such. Yeah, exactly. So that's where I announced the project because everyone was there back then. And I was like, listen, guys, I want to learn more about trading. I want to learn more about programming. And I want to get into this open source thing. I really value open source. I still do. Unfortunately, it's a little bit harder right now. So I started with Gekko. And Gekko started as a super simple way for me to trade because I got into Bitcoin. I was like, well, what are the things you can do in the cryptocurrency landscape? So I looked at mining, but mining back then already was getting really professional. And me, as someone living in Europe at the time, where the electricity costs are really high, and so it's a very, very hard game to get into. It still is. It's even harder now, but it was really hard back then.
Right.
This is when there was just a switch away from graphical cards for Bitcoin to ASICs.
Mm-hmm.
So before that, yeah, you did had a lot of hobbyists and tinkerers and such who had like their own little mining farm with a bunch of graphic cards. But like when I got into it, it was just getting out of that. I did actually when I in my first days in crypto, I did actually mine a little bit on I had a gaming computer, so with a beefy graphic card. I think I mined like zero point 0.2 Bitcoin over the course of like 2 months or so. In like for the mining pool BTC Guild, like it all doesn't exist anymore, but like it was fun. It was fun. But I think back then Bitcoin was very cheap, so I think the electricity costs were more than the Bitcoin. But I was living back home with my parents and such, so it didn't really matter. For me anyway. So then I started focusing on trading and open source. So I started with Gekko, and in the very beginning, Gekko was a very simple script designed to let me trade a strategy without getting my emotions involved. Because whenever I try to manually trade, like looking at charts, like drawing some lines, using some indicators, stuff like that, I figured out really, really quickly I'm really bad at that because emotions come into play. And you're trying to make a prediction. It was very tough for me, so I was like, what I'm going to do instead is I'm going to look historically at patterns, and that turned out to become Gekko. And then there are some really easy patterns, like for example, like you could smoothen the price of, for example, Bitcoin dollar into like a moving average. So it's like basically you smoothen it, and then you can kind of see that like is the line, like the average smoothed line, is it going up or down? Very simply said. And then if it's going up, then we assume it to go up for longer. We are now in an uptrend. We're going to trade, we're going to buy because we think that it will go higher in the future. And vice versa, we will sell. And that's what Gekko was. And when it came out, it was the only thing it could do, and it could only do on Mt. Gox, the Mt. Gox exchange. And yeah, but it got on straight away. So I posted that on the code on GitHub. I had a conversation going on Bitcoin Talk. People liked it. Slowly over time, I added more exchanges. Like I think the next two exchanges were like BTCE, sorry, that was a Russian exchange, as well as I think it was Bitstamp, which is still around.
I remember using it on Bitstamp. Yep.
Oh,
and then
really?
Bitstamp changed their API, I think, around about that 2015 mark, and it broke for a while. But yeah.
Yeah, that's true. So as the time went on, I added more and more exchange support. And what you see in crypto exchanges is that they tend to change their APIs. The API is the technical interface you use when you program trading software or bots or whatever. And they tend to change a lot. And I think in 2015, late 2015, I can't quite remember, but Gekko probably supported around 10 exchanges at the time. And all of them were constantly changing their API. So it was a lot of work for me to maintain. So in the first few years, actually, of me doing Gekko, it was actually just a hobby. So I was, I think I was still doing college, right? So still graduating for the first year and a half or so of doing Gekko. And after that, I got into I took a job. I took multiple jobs. But back then, actually, crypto was very small. So there weren't actually that many professional traders. Like you had a few like trading desks and trading shops that we still have today that were coming out back then, but it was very, very small. I'm talking about when like even Bitcoin exchanges were like considered like risky startups, right? Like when Coinbase came out, Bitfinex a little bit older. I think Bitfinex was 12 maybe, but and Bitstamp and all of them they were just out. No one trusted them, right? And so you can imagine as a trader, it was even harder. Like the volumes were low. There were not that many things you could do. Liquidity was bad. Spreads were very wide. Right? If you're a trader, you want to be able to get trade in and out of positions quickly and cheaply. Really wasn't possible. The fees were extremely high as well because the exchanges still need to make money with less volume, so they had to have higher fees than they have now. So it was So for first years, it was actually I was doing Gekko in my spare time, which was great, actually. It was a great learning, and it was a great, I met lots of great people, smart people. I learned a lot from myself and making mistakes and learning through that way, as well as people coming into the Gekko in the repo on GitHub and saying, no, you should architecture or structure things differently because it will be smarter, this and that. No, it's great. Still is, unfortunately, I'm not working on Gekko anymore now. We'll go into later, I think, what I'm doing now. But yeah, so that was the first few years. Unfortunately, I was actually not working professionally in crypto or blockchain just out of college up until I think back here up until like mid 2016, and that's when I got back. I got into blockchain actually because still in mid 2016 trading was small. I was doing it as a hobby. I was still doing Gekko, but I did see this whole boom in blockchain, like private blockchain stuff for banks and big corporate institutions. So I did that for a while. I was a blockchain engineer for a Dutch bank called ING. But in my spare time, I was still doing Gekko. But like, unfortunately, professionally, that was the only thing I was doing crypto. And then we had 2017, and that was kind of like the crazy run up in Bitcoin, right? When a lot of people heard about it, it was in the news a lot and everything. And that's actually when I saw, whoa, this trading is actually can be a viable kind of source of income for a trader. And that's kind of when I started going full on ahead. So if you look at right now, I run a trading firm called Volkwang. So that's me and a few other guys. We're pretty small. And we just do trading, and that's all we do. And so our the money we make is just from profit in the market, so to say. But it took a long while to get there. And if you look at our strategies as well, like they really evolved over time. Not per se in terms of getting better, but in terms of like I found a better fit with what I like to do and what I'm good at. So let me see. So in 2017, I was actually doing I was just still doing a lot of Gekko stuff. So Gekko, as I said before, is very much about predicting a trend. But over time, I found that to become increasingly hard problem. Like actually back in 2013, the markets were extremely trending actually. There were like not many like very weird crashes and very weird patterns. You had a flash crash once in a while, but it was not like how things are now. And so I found that to become harder and harder. And at the same time, I discovered a love for like very fast trading, so arbitrage stuff like that. So it's called like high frequency trading. I found a love for that, and that was actually in the 2017 bull run when I don't know if you guys can add a link later. Let me actually just look up the link here. So I was from the beginning of 2017. I was building besides Gekko. Oh shit! I see something. A link is down. I will post here anyway, and the link will go up soon. I'll just put it in the comment here. If you guys can post that. Yeah, so right now, unfortunately, the link doesn't work. I'll fix it later. But yeah, this link describes one of my first arbitrage systems I was building in 2017. And I was really lucky because I started building it in like March 2017, which was when the market was really quiet, like nothing was happening. But then it was running, and it was like running full steam by the time late 2017 when like everything went completely crazy. And and if you were doing arbitrage when things were completely crazy, it was very very profitable. So in late 2017, actually, this little arbitrage system that the link describes called Agent Smith was actually making more than I was making for my job for a little while because the markets were going. I mean, I was the only one here. Like, I mean, everyone who kind of sat on some Bitcoin from like start 2017 was when Bitcoin was like $1,000 up until 20,000 at the top. Like everyone made a lot, of course. But doing arbitrage was like I was kind of blown away by what was possible there. Especially with someone from my like my only real background was doing Gekko in my spare time a few years before that. So and basically after that it kind of took off, and I just so I quit my job late 2017 at the bank to do full-time trading for myself, and then now that kind of moved that evolved into a company, so to say. So that's the short version.
Fascinating journey.
Yeah, and we've got a few more questions for you as well around that journey, and I think you've kind of touched on it a little bit there already. Of kind of you do seem to prefer some of the more algorithmic side of trading rather than discretionary. Is there something there that is kind of almost forming into more of a thesis, perhaps bringing it forward into what your prop desk is doing now, and from a trading perspective?
Sure, yeah. So, well, I mean, everyone has their own strengths and weaknesses, and I think I found out really early on in literally the first weeks of trading for me that discretionary trading is not my strength. I have some strengths, and they're not. It's just you're controlling the emotion. So I do follow a lot of traders, discretionary traders. at different types as well. Like some trade surprise, some trade volatility, some trade basis, or like right now the crypto markets are pretty sophisticated in terms of what you can trade and how you can trade. So I follow a lot of discretionary traders. I happen to learn over time. It's not my own strength. So I think you should always do what you shouldn't do what people who you look up to do per se. You should do what you find out yourself are good at. So even though I have a lot of respect for these people, and I want to be like them in a way, it's not my own strength. You got to play your strengths, right? And and what I really learned is that like my strengths are actually just a little bit different than what I thought in the beginning. So Gekko is, for example, it's all about like predicting trends using historical data. So it's actually very statistical heavy. And even though I build all these algos and quant models and such, like statistics is actually like I'm okay at it. I'm decent, I think, like relatively speaking, across other things. But I'm actually like a better engineer in terms of like building software that's, for example, really fast. So if you look at what we do now, like a lot of it is like flat arbitrage, where like we like if there's a very big seller on BitMEX, for example. Then we might be a market maker on BitMEX, or what we might be buying, and then really quick we raise somewhere else to sell. So technically speaking, BitMEX is hosted in Ireland. That's where the server is, and then so Binance and a lot of other exchanges like FTX and Huobi, OKX, they're all like around Japan in Tokyo. So Ireland to Tokyo is like pretty far and pretty slow for the internet. So doing all of that efficiently and quickly, I found that to be that's actually like, for most people that's probably a harder problem, but for me that's a lot easier actually than discretionary or worried about the risk of the price doing certain things. Like as we saw yesterday, right? Like I don't know. So just for people who are watching later, not in real time. Yesterday, the 19th of April or the 18th of April, sorry, it was a big crash. You guys covered it already. I saw as well. It was a big crash, and it was. I didn't see it coming. Like I saw a few patterns, like whoa, the market's really overheated, but I've seen these patterns. Like to be completely honest with you guys, like I've been seeing these trends for a while now. So for me, it wasn't really clear why yesterday things went down and why things did not go down last week, and are things gonna go down more? Like I don't know, to be honest, right? But what I did know is that when the price goes down really quick, there's panic in the markets. There's chaos. Everyone's trying to sell. A lot of people, they already had their stop limits and their stop markets and their everything in place. Other people got liquidated, unfortunately. There's a lot of stuff happening everywhere at the same time, and it creates opportunities. I mean, no, don't get me wrong. Like I'm definitely a crypto person. I want crypto to go up, but I know that it doesn't always go up. So when things like yesterday happen, it's easier to seize them, so to say, and that's exactly what we do now. So like I prefer to not be in the business of like predicting the future, but I prefer to be in the business of like when something happens, being able to like get in on it as good as possible. And I like overall, like we if you look specifically yesterday, there were major opportunities, and we didn't seize all of them, but we're in a pretty good position to seize a lot of them, so to say, like because we've seen these flash crashes happening for years now.
Right.
So it's just I found that to be it fits me better, so to say, than discretionary trading.
Yeah. No, totally. In fact, I want to mention a couple of things and dig in a little deeper on some of what you already spoke about. So if you really think about it, as they say, right, when it comes to algorithms, it's not so much about predicting, but it's about reacting, right? Like you find the right moment and react properly and appropriately, right, and take advantage of the situation, right? So it certainly seems like you do have that as your foundational piece in the strategy. What I would like to understand a little bit more, Mike, is you touched upon quite a few things, right? Like you definitely touched upon the fact that trading has evolved; it has become more advanced, right? People are now more sophisticated, right? Some are doing arbitrage type trading, some are doing just basis trading, some are doing more directional trend following trading, and there are plenty of other types of traders, right? Some of course have overlaps, some are sort of other sides of the table, but the whole market is evolving. What is your favorite sort of strategy, if you may? You did explain that you're certainly looking for algorithmic opportunities, if you may, right, wherever the market allows for some kind of a trade. But which ones are your favorites? Do you tend to do more derivatives? Are you more on the spot side? Do you look at more of spreads basis arbitrage type of stuff? Are you more of a trend trader? And tell us a little bit more about that. How you approach the market.
Sure. So right now, I'd say this is just we kind of slowly moved into the corner we are now by a combination of past experience, past things you tried, luck, all these kind of things. Where we are right now, we're pretty comfortable. But we are seeing a lot of other fields that we are not that active in. We want to be more active. But right now, our bread and butter really is doing like very low spread arbitrage. Mostly between perpetual swaps, between different exchanges. So we do a lot of like cross-venue arbitrage, and a lot of what we do is called market neutral or delta neutral trading, meaning that like at any point in time you don't have much position, because as I said as well, like I found it extremely hard to kind of like generally predict where the price is going to go. Right now we are able to trade in a way where that doesn't actually matter. So we are constantly buying. For example, and when you buy, you take a long position into the market, right? But right now, what we do is as soon as you buy, we also sell. Usually around at the same time. Like there can be a little bit of a time in between there, but it's never more than a minute. That's kind of the time scale. And this is all automated, of course, right? So a lot of our trading is market neutral. And then what do we trade? Like, how do we actually make money by not being exposed to like Bitcoin going up, for example? There's price differences. So between these perpetuals, as I said, yesterday we saw a lot of price differences. So for example, like a practical example here is that like when there's a very big market move, the amount of tether. So tether is a very big topic. The amount of tether that's available on very specific exchanges, it's like there's always some kind of like there's an imbalance somewhere, so you can see the prices drifting. So what we saw yesterday is that like a lot of perpetuals are priced against tether, while others are priced against dollar. And for a short while yesterday, for like an hour or so, those drifted apart for like over 0.5%, like literally all of them. So I'm talking about the Binance perpetuals, which are arguably the biggest perpetuals in the world right now, compared to like other markets like BitMEX, Deribit, FTX, who are all priced in dollar or synthetic dollar because they're coin margined. I don't want to get too technical, but basically like because of the tiny little difference there, like you're saying, well, 0.5% is actually not too much. Because Bitcoin went down 12%, and I'm talking here about this 0.5% difference. It doesn't sound that interesting, but it's relatively safer because this is specific tether, and a lot of people have opinions about tether. But you can also look at it like, even if you compare BitMEX, which was like a Bitcoin dollar or synthetic dollar, versus even Deribit, like there's exchanges that are like geographically close to each other. They're very similar to each other in terms of the product offerings and such. They were very far apart, and very far. They're not 12% like the Bitcoin crash, but even if they are like 1% apart, like you can trade at that size because they're gonna get back. Exactly. So that's the type of trading we do now. We're also pretty big in the futures. So these are the expiring futures.
Sure.
And we're getting bigger in options. But I do have to say that's really like that's what the company is doing. So the company's called Volkfang. But that's not really me. Like we have a guy on the team, and he's an option guru, as that's Jeff. And so it's not really fair for me to talk about it. But we're getting more and more into that. So what we are noticing is that the space is getting more sophisticated. Like so, there's more products coming out. More products are growing. There's more liquidity everywhere. So we're just seeing more and more like opportunities, specifically in the derivative space. Also in the DeFi space, but that's an example of a space that we're doing some things and we're actively exploring it, but we want to get a bigger presence in DeFi, and then different DeFis as well. Like you got ETH, you got Binance Smart Chain, you got Solana, you got a few other things as well. There's so much happening. So for us, really, it's kind of like figuring out what we want to do. But as I said, like over the years we moved towards this like low spread, low latency arbitrage, mostly between perps. So that's been our bread and butter. So we did a lot of that yesterday.
Fantastic.
Yeah, and I'd like to pull in one of the audience questions because I think they're asking this based on a comment you made a little bit earlier about being delta neutral. So this question's just looking at how you hedge your risk, especially with some of the altcoins that go crazy, a bit like Ripple or Doge, or it might be more volatile than some of the majors.
Yeah, so there's a few risks here. So the first risk is market risk, or called delta, which is that like if you're a market maker, you're always willing to buy and sell, right? And if the price goes up really quick, you are the one selling because other people are buying into you as the market maker, right? So that's the first risk, and it's by far the biggest risk. And in crypto, it's extremely hard to manage. So if you look at most big market makers, I'm talking about the really big firms. They hedge either everything or almost everything out straight away. So meaning as soon as you sell, you go buy somewhere else.
Right.
And a lot of that is what we do. Like traditionally in traditional markets, you have a lot of market makers, even very big ones, even banks and such, and they hedge based on inventory. So they're basically like, well, we know that once in a while the price is going to spike up, and we're going to get run over, as it's called. The market maker is going to get run over. We'll lose some money, but over time we make more than we lose by, usually it's kind of stable. And also stocks, they rarely go as crazy as crypto. So it's relatively safe, right? Like if Apple crashes really hard, like they're still gonna sell a lot of iPhones next year, so it's still a safe thing to buy, right? Even though you're buying it at a bad price for a moment. So that's the first thing. That's delta. But the second big risk, and especially what we saw yesterday, is if there's a lot of volatility, you're dealing with margin, especially in derivatives, right? Because so we might have a long in one place and a short somewhere else. It is a very simplistic scenario of how you can be hedged out. But then, yeah, like, if you're short somewhere, if you're long somewhere and then the price goes down, like at some point it's going to eat into your margin. So be careful about the leverage is the first thing. And be very efficient. Like what we saw yesterday is that when the price was crashing, it was impossible for almost an hour to kind of move money around. Like ETH was clogged, Bitcoin was clogged, all the exchanges had if you request a withdrawal, it's gonna take an hour before they send it out, and then the blockchain is slow. Our advantage is we have been doing this for a while now. So basically, like since 2017 is when we kind of got into this type of trading. Very late 2017. And as such, we kind of have gone through that a few times. So we always have some extra money on each exchange that you trade on. So you're able to kind of, play that. And the other thing you can do is if worse comes to worse and the price just keeps going down and you have very long, at some point you can just sell your position. And you'll probably do that at a loss, probably. But it's better than being liquidated, usually, almost always.
Right.
As such, so those are kind of like the biggest things, but it's scary and it's hard. So as we've been doing this, like that's basically like we had to learn a whole lot of new tricks, and I think we can still get better at it. Like if you look at like yesterday specifically, for example, like our risk was okay. We did not get liquidated anywhere. So everything was nice, but I think in terms of our capital efficiency, like we have a certain amount of money. How good were we able to effectively use that money to trade? We might have been able to take a few more risks in some scenarios. So like optimizing for that is a very, very tough problem. And I think you can never have it perfect. It's just about getting better constantly. So that's the answer to that one. Yeah.
Yeah. Another one here from Leo is just kind of looking at whether trading on margin perhaps gives exchanges an unfair advantage over traders in very volatile markets like yesterday. What's your take on that?
Probably yes, but in a different way than I'm not sure how this is intended. But what we do see a lot is that you've got many traders and they trade on very, very high leverage. And this is facilitated by the exchange up to the degree where, like, if like the very practical example here is BitMEX, right? So they came out with like the 100x perpetual swap. I think they were the first to do 100x. I think before that was like 10x on the Chinese future exchanges. I might
now
be wrong.
it's
Maybe
everywhere.
They were not the first, but now it's everywhere. Now it could go even higher, right? Like on Binance, I think it's 250x or something.
Correct on some, yes.
And the way we see it is that that's almost always unsafe. And so on BitMEX specifically, they have this little slider with the leverage, right? And it's like, it's this little bar indicating your progress on like how much leverage are you using, and like and visually it's definitely like they design it a little bit as well. Well, if you're 20x, it's really, really safe because it's not 100x. But we personally feel that 20x is also not safe at all in many situations. Like yesterday, right? Like we had a 10% move, so like everything. on Bitcoin. Right? On alts, it went even crazier, right? So even on Bitcoin, if you're 10x, you would have got liquidated yesterday if you were on the wrong side, right? So in that sense, yes, and we also think that exchanges, they should be a little bit more responsible in that sense. But I think that's the main thing, because at the end of the day, so in terms of other unfair advantages that margin could bring, like I think in most situations, like traders are trading against each other, and margin is also provided by other traders to some degree, right? So if you look at perpetuals, the margin is actually is synthetical, but it comes from other traders. It comes from the other side. So it's all baked in the pool of open interest. I want to get too technical, but it's not really that like you're paying the exchange for margin. That said, this does happen on some exchanges. Usually the rates are market fair, so to say. So it's not really that you're getting an unfair deal. Like I'm talking about exchanges where you can like margin trade spot, but it's not peer to peer. So I'm not talking about the Phoenix or FTX or I think Kraken. Not sure about that one. But I would call it unfair, but I would call it a little bit deceptive sometimes in terms of the practices when it comes to leverage and risk. Yeah, so similar to like you got leverage tokens. It's a whole other. I got a lot of opinions about that as well. But I think that should probably answer the question. If not, do a follow.
Yeah, we've got one last one here from Eden. Yeah, around the big trading firms. Are they still big enough that one firm could move a market, or a couple of them acting coordination, or is it really so fragmented that it's even smaller firms like your own are still feeling like it's a market movement rather than something led by a cabal or a fewer larger firms?
Nice to hear, by the way, Eden. A good question as well. I actually believe that like there is more. So there is actually a lot of concentration happening right now. There are a few very, very big trading firms in the space, and given the amount of opportunities that there have been over the last few years, they made ridiculous amount of money, like amounts of money that I wasn't really expect to see in crypto. If you look at, especially if you look at the public stuff, right? Like, so you got a few, a traditional trading firm from Wall Street that's very active in crypto is called Jump Trading. You got a few crypto native firms like for example Alameda Research. You got like Three Arrows, who they used to be Forex, but they're like full on crypto native now. And just if you look at their public stuff, like the amount of money that they're moving around on DeFi, like at this stage you're talking billions of dollars. It's crazy. It's unfathomable. And so in that sense, there might be more concentration risk, or there might actually be less segmentation in that space than there used to be. And this is specifically bad if you talk about alts, right? So a lot of these companies are also very active into sharing their research and talking about what they think is going to be the future of DeFi and selling their bags. So I don't want to go into names and stuff, but like you do see that, and then with the sheer amount of money that some of these firms have through their exposure, it's insane. So if you look at yesterday, I do think, for example, that like as things went down, I'm not really giving a prediction, or I'm not really stating like this is exactly what happened, but I think it's very, very likely that you have a few big firms and they're pretty bullish medium term on Bitcoin. And as things crashed down really hard, they just started buying extremely aggressively up to the point where it just stabilized the price. Yes, I think that happens. I wouldn't really call it manipulation or something like that, but there's definitely risk, of course, right? It's definitely not that decentralized, or not that where like I do think the actions of some really big firms can actually impact what happens. But generally speaking, right now they don't really do it to I do want to make it very, very clear with this. Like, I don't think they do it to hurt retail. Like, many people think that market makers are stop hunting, or they're like painting the tape or stuff like that to like get other people to make money. I don't think that's happening. I definitely like it's too the markets are too big, and there are too many of them right now to do that efficiently. Because even if they're able to like move the price on like one market, like imagine they do it on like BitMEX, for example, you got people like us doing arbitrage against that, right? So if someone starts really aggressively buying on BitMEX, they have to buy it from us, and we're gonna they have to lift the price like everywhere on the whole world in order to kind of actually move the price. So yeah, keep that in mind. Keep that in mind. But there are really, really big firms out.
So that's actually a great point you just made, Mike, which is around, of course, inefficiencies, and then some traders taking advantage of it, via arbitrage or other means, and sort of bringing it back to sanity, if you may, or bringing it back to an efficient market, right? Like that's sort of the behavior of the market in general. What I want to specifically get to and get your take on is, a few days back, we saw this massive contango in the market where, the futures price and, the spot price had deviated quite a bit. And in fact, in some cases, when it comes to these sort of periodic futures, not the perpetual contracts, we in fact even saw that on that given day when it was finally settling, there was a big gap. There was a big sort of, money to be made. What's your take on it? What's going on there? How do you view it?
Oh, well, we're definitely in a bull market. There's a lot of money. A lot of people are very, very bullish. And so if you look at it, what's the easiest way to buy a lot of anything in crypto, really, very capital efficient, it's of course through the futures. The perps as well, but they get arbed a lot more aggressively because of the funding element, right? But also the future. So if you start buying futures really aggressively, you'll see the basis going up a lot more aggressively, and it takes longer to kind of correct. So it's more obvious in futures. And generally speaking, they're also like, most of them are less liquid than the perp. So if someone starts buying aggressively, like it will push it up. And no, you're very right. And we even saw big names like on Bitcoins. Like if you look at Bitcoin and ETH, we saw way over 50% annualized basis on some of these expiring futures. Crazy stuff. Yeah, no, yeah, we think there's just an awful lot of money coming into the space right now. And there's just not enough market makers and ARB like us being in there to kind of, because we are on the other side, right? So as people are buying the future, we are then selling the future at the same time buying spot, so to kind of bring those prices closer, right? But because of the sheer amount of buying in the last few months, there's just not enough people like us, so to say. So it pushes things out of whack for a while. And specifically what you said, like just before the end of settlement, settlement is just generally speaking very messy, especially because many things are USD settled. I am not a big believer in everything needs to be like physically delivered, but because I still think that the majority of volume and the majority of big traders that have very big future positions, they roll them over before they expire. So I maybe it's a little bit different with options and a little bit, but what we've seen so far is that like in terms of the very big alt futures and the big Bitcoin futures, is that like a lot of the OI, the open interest, actually disappears before settlement. Like not everything settles. But for the part that sticks around, settlement is just pretty messy to trade properly. Because you got different futures and they don't settle at the same time usually, like there's a few hours in between. If you look at like the Deribit versus FTX, for example, they do it a little bit different. Spot can get very messy around settlement. So for example, if you hold your position, you have a future position and you're just gonna let it settle, and at the same time it settles, you want to trade out of a spot, like you're doing an ARB, for example. It's pretty hairy. It's pretty messy. So yeah, as such, you see these opportunities, but they're quite hard to capture. That's kind of how we see it.
Yeah, absolutely.
So we wrote a lot over before we trade a lot the quarterlies on different alts, on Bitcoin. A lot of it is hedging as well. That we have certain spot balance for some spot market making or something. We hedge out on the future, stuff like that.
Right.
And generally speaking, we roll it over we don't wait around for settlement. Like we do that a week before, and then we just don't have to worry about settlement.
Fair enough. Yeah, fair enough, and sounds good. I just want to ask one more question that sort of relates to risk that was discussed a little while back. We have seen exchanges, of course, getting more and more innovative when it comes to, the types of products. We spoke about the high leverage, which is, of course, also the reason why we see a lot of these leverage trades and liquidations and so on and so forth. But there's another aspect to it, which is essentially the collateral, right? So there is an interesting amount of innovation going on there. Certainly there's stable coin as collateral. Then there's the instrument itself, the coin-based collateral, where the contract then ends up behaving a little bit more like an inverse contract in terms of payouts. And then we've also had these sort of cross-instrument margins, right? Like the Binances of the world have really sort of promoted that, where it says if you're trading a bunch of them, you could do, a sort of a pool, if you may, of margin, right? Like kind of a cross margin, if you may, and a few others have followed that. How do you view that evolving? What's your take on it? In terms of risk management, I presume it just makes it more difficult, doesn't it?
Oh, actually, no, it makes it easier. No, this is great for us. So we're very, very happy that we're seeing all of this come out now. No. Giving people choice in terms of their collateral, for example. We love it because it allows us to manage things a lot more efficient. No. For us, it's great. I mean, yeah, you're right. Like it's a lot more complicated. Specifically, if you look at places like Binance, what they end up doing is they have, for example, they have a lot of perpetuals. They have right now Binance. They have one perpetual that's margined in Bitcoin, and they have one perpetual that's margined in Tether, and they have one perpetual that's margined in BUSD. That one's still pretty small. So BUSD is the PAX stablecoin, which is a lot more one-to-one than Tether. So they just have three different products, three different markets. So from that perspective, it's harder because we want to trade all of them. So we have to now we have to have some Tether. We have to have, and they have different order books, right? So you have different positions on them. The OI is different, liquidity is different, the flow is different. So in that sense, it's more. That's the Binance way of doing things. And then if you look at, so for example, FTX, right. they are definitely innovating in terms of you can just put whatever you want in your wallet. And everything you can use collateral, but at the end of the day, things are collateralized in dollars. So meaning if you don't have dollar, we have something else. We'll go and borrow some dollars automatically with your other thing as collateral. That's actually the things you can do with that. It's insane. So for us, it just creates a lot more opportunity. As well as on top of that, you can also lend your money out, which is I'm not sure if it's inspired by, but similar to the old Bitfinex and the old Poloniex, peer-to-peer model, peer-to-peer lending model, where you got a spot margin trading, and the people who do that, they borrow from other people who are lending it out, and they get an interest for that. There's a lot of innovation happening. Generally speaking, we really like it. But yeah, dealing with all these different types of collateral in these different derivatives, I just say it's a lot of work. But over the years we've kind of optimized for that. You kind of have to if you want to trade all these things. It's a lot of work. So we are kind of set up to do this pretty efficiently on a pretty big scale. So with the coin margined perpetuals and futures, where the same coin is being used as collateral. So in Bitcoin, it's relatively easy. So it's just Bitcoin. But if right now we also want to do it in Doge and in Filecoin, meaning we have a lot of Doge and a lot of Filecoin that we have to back all these positions with, right? And it gets a little bit hairy when the price starts moving, because if Dogecoin crashes and we have $100,000 Doge, yeah, exactly, and that goes down as well. Right. So you have to be a little bit smart about that. Exactly. So the fortunate thing about us is that we're algorithmic, and we everything's automated, so we can just these things are very predictable. It's very predictable. If Doge goes down, your collateral is now worth this much less, right? It's not rocket science in that sense. So you can prepare for it. It's a lot of work, but we put in the work. So we have a lot of automated system managing all of that right now. So
that's cool. Yeah.
Be sure that you're smart about it, and for traders who are not algorithmic, be sure that you always keep these risks in mind, right? And also the payout's different as well, as you were saying, right? The convexity on the inverse contracts is different. Exactly. Keep these things in mind. Usually they're kind of subtle, but they can completely fuck you over in the wrong time. So keep everything in mind. It's just it's a lot of work, a lot of planning, but yeah.
Yeah, and I mean, we've discussed so many different instruments already in the call today, and I know some of them, like you mentioned, options, might be someone else in your firm, that's what they're specialized in. You personally, what is your favorite instrument? And is there an instrument that doesn't exist yet that you'd like to see?
Generally speaking, I really love perpetuals, and this took me a while. I used to hate perpetuals because with the perpetual you pay funding, which is completely random. It's very understandable where it comes from. But if you randomly trade in a perp and then you go away from your computer for 2 days or something, you might just end up paying a lot of funding because the market made a move. It's kind of unless you're on top of it. That's the downside of it. But generally speaking, I think they're really big. They make it a lot easier than the expiring futures, because before the perpetual was kind of like, made famous by BitMEX. You had expiring futures on like Huobi and OKCoin back in the day, the Chinese exchanges, and you could go 10x, and it was a big innovation already in the crypto landscape. But for me, it was always hard to kind of deal with expiring futures. It's kind of like, why is it trading? So this one is like $2,000 more than actual Bitcoin. Like, why is that? And is it going to change? And sometimes it does change, right? Like you might go long on the future, and then generally speaking, Bitcoin goes up, but you still lose out because the basis shrinks or something, right? Like these like conceptually and mentally, these things are very hard to think about for many traders, and that's what I think the perpetual swap is great for, because it never fluctuates that much compared to the futures, right? The other thing I like is like you guys are familiar with the leverage tokens. So leverage tokens are wrapped leverage positions in a token, effectively speaking. Right. So basically, someone else goes and does a 3x position, and they manage it, automatically rebalancing it based on the collateral, and basically and representing that in a token.
Yeah, I think FTX has a bunch of them, doesn't it?
Yes, they innovated it. They innovated it because their background of a lot of these guys, including Sam, is like ETF trader. It's very similar to an ETF in that sense on traditional markets.
Yeah.
But the unfortunate consequence is that crypto is extremely volatile, and they can, if there's extreme volatility, these things can go to zero, or they can go very low. They can go lower than mathematically you expect them to behave. Let me put it this way. Like I'm not saying it's risky. There are some risks, and they're quite hard to explain, and they're quite hard to conceptualize as well when you trade into them. So it's a little bit. It's tricky, but I do see a lot of potential here. But what I find will be extremely innovating, and you kind of see this a lot in DeFi already, if you look at things like synthetics and such, is leverage tokens that are actually not based on a real position, but they're based on some kind of formula or like a synthetic position.
Right.
I see a lot of stuff, like a lot of opportunity there, where like you have a leverage token that actually like precisely according to some formula, according to some base price, trades exactly to the multiplication of some of some price move. But it's still tricky, so to say. It's still like at the end of the day, like the most traded products in crypto are retail products. Like retail is a very big part of the space. And that makes it so that as soon as you get into exotics and as soon as you get into like really complicated derivatives, people either don't understand or that's really, really what I see. Like this is how we look at options, for example. So just like plain options. I'm not even talking about exotics that you see offered by Deribit, for example, and now more and more exchanges. But Deribit is really the market leader here. Right. They're growing. Options are growing, but mainly because the institutional side is growing, right? Like the only really people, like non-institutional people that trade options on Deribit, most of them, they do a lot of reading and they really get into it, or they are volatility traders or option traders from, familiar with it. And that's kind of like, we need to break that at some point. I do hope the whole space to grow up a little bit and yeah, if you guys see what I mean, in terms of that we can get more complicated stuff. That actually is traded at scale as well. Like options are growing, and I'm very happy for it. With it as well, like we are pretty active in those. But yeah, like right now, like everything is in the perps because that's where like all the retail is at, right?
That's correct.
That's kind of how we.
Yeah. No. So you make another, bunch of really good points there. One is that, of course, thank you for sharing the instruments that you like, but also the fact that retail is the big, sort of the participants in the ecosystem, and the instruments need to be simple enough for retail to deal with, right? They should be able to understand it, trade it, understand the risks. And I think the moment you start looking into any fancy instrument, a little bit more esoteric, a little more exotic, it becomes very hard for an average trader to even figure out or grok it, right? How to enter it, what to do, what the risk is. Now, one area, of course, that retail has fallen in love with is DeFi. Right? We've seen that the rise of DeFi since last year. We in fact did a whole session on that as well in our show, and we've covered that a few times. The 2020 summers was really the summers of DeFi, and from there the story has just become bigger and bigger and bigger. We understand from all that you've shared so far, you are primary plays, in the sort of perpetuals, futures, options in the centralized world, because there's a lot of liquidity, there's lots going on. We would love to know how you are viewing DeFi, right? And is yield farming and synthetic tokens and DeFi, is that also part of your umbrella? Is that making you curious? How are you sort of trying to enter that segment?
Oh, I love that fight. Don't get me wrong, and especially for lots of reasons. I think so. Yes, there's a lot of opportunity. There's a lot of interesting innovation coming out. Like overall, it's just, it's a blast, and also like fundamentally, like if I go back to why I originally joined crypto, it really was for like this decentralized finance revolution. That's kind of why I got into it in the first place. And I didn't really see that. Like, no, it's great that you have all these centralized exchanges, and they're doing, in a lot of ways, they're also protecting people, because dealing with private keys and not getting hacked is very very hard, also for retail, right? But still, the DeFi we're seeing now is kind of what I actually hoped for back into late 2012, early 2013 when I got into it. So I'm super excited to see it. And if I was a starting trader right now, even algorithmically, that's probably all I would focus on. It's just right now, it's just that we are already very active, and we have a pretty big presence on some of the centralized exchanges, which is why we're very active there. We're trying to go to DeFi stuff, but there's so much happening right now. But no, we're loving it. So there's real innovation coming out. That's how we kind of see it in terms of many protocols, like the way you're able to combine them. There's a lot of edges, a lot of alpha. There's a lot of opportunities to seize. No, we're in it. So in terms of what we're doing, it's pretty light. We do a little bit of farming. Keep it like you, as I'm pretty sure everyone who knows a little bit about farming is familiar with like what's in crypto called like the impermanent loss, or the risk if you are an LP in a Uniswap or SushiSwap kind of pool, where you have a crypto coin and like a stable coin, or a crypto coin and another crypto coin, where they're not really correlated. So not like a stable coin pool or something. You have the big risk, right? Of like, if the price drifts, you always end up on the wrong side, unless it drifts back. But in crypto, many times that doesn't happen. So there is risk there. So I do want to say, like, be smart about it. Be smart about it. Look at different opportunities. So what we do, for example, is like, we try to hedge out that risk. So sometimes there's a farm, and there's like, whoa, this yield is great. Like, we want to get this yield. However, we see that there's a massive risk in terms of the price moving the wrong way. And we are just getting, so sometimes we're able to hedge that out. Like, sometimes you can do it with options. Sometimes you can do it with a margin borrow. Sometimes you can do it on a perp, for example. If you do with options, it's probably quite easy to do manually, as in you don't have to constantly re-hedge as the price changes. If you do it on a Delta One project like a perp or something, then you probably do need to hedge. So we have the advantage that for us it's relatively easy to build bots that can do this for us. So that's a little bit harder for others maybe. But even if you stay away from that, or even if you're like, well, if you calculate the risk out, like, well, like, I'm exposed to this downside if the price moves this much, and the yield is this, as such, I think it's, I think I will likely make more than I will lose, for example. Even that way, there's a lot. If I would start out right now and I wouldn't have anything, I wouldn't have all the centralized exchange stuff. I'm pretty sure that's all I would be doing. That fight. It's like there's a lot right now. And because of the new innovations and the new products, which are completely different from anywhere else, there's like, if you're really smart, you can find like arbitrages and stuff and yields, and you can find constructions that are like, they're so unusual and so new. So if you're smart about it and you think about it, like, there's a lot. And of course, DeFi also opens the door, like, lastly, for a lot of people in the world that have been excluded from all the perpetual fund that we've been seeing, like, for example, Americans, right, or people living or citizens from the United States. They've been unfortunately not really able to participate in all the derivative fund that we've been seeing on centralized exchanges. And maybe there's a way in for them as well in DeFi. We'll see. But that's also a big angle to it, of course. We are extremely hyped. So one of our big aims going forward is becoming a lot bigger and a lot more active in DeFi.
Excellent.
Yeah, that's really exciting to hear. Now, we're almost coming up to 1 hour. We do have a follow-up question from one of the audience members, and then I'd love to throw some rapid-fire questions at you. So firstly, the question that we had here was follow-up before, and it's really talking about when you've got those large alt positions, like you mentioned Doge, can you hedge a certain amount against other assets just based on the correlation?
Yes, you can. This is actually a great point. It's a great idea because, as we saw yesterday, things are correlated, and they're generally speaking they're more correlated when they go down than when they go up. Like when Bitcoin crashes, everything crashes, right? As we all
Yep.
know. Yes, there's a lot of correlation, and as such, you can be extremely smart about this hedging. So, for example, you can hedge using an alt. But I do want to point out this does introduce a risk, right? Like it is very possible, especially some coins like Doge and Ripple. We found those to be less. They really go their own way, which is the TikTok way, in terms of right. Like so, it doesn't always hold up. But you can do some statistical analysis here, and generally over time these things can be stable. Like, but you open up yourself more to risk. So it's more about like, what's the reward risk scenario here? Like with alts, generally speaking, the risk reward scenario is that trading alts, hedging them out on Bitcoin is that like there's more liquidity in Bitcoin. So you get better prices, it's easier, stuff like that. But then the risk is that the correlation breaks, right? So it's kind of, you have to make your own kind of analysis there, and you have to keep in mind that the correlation can always break at any point, right? Like so with Ripple, for example, when there's a lawsuit, right now there's a lawsuit, whenever news comes out about the lawsuit, that might not affect Bitcoin as much as it does Ripple, right? Like as a practical example. So keep all these things in mind. But yes, you can generally do this. What is safer than using different coins is using different products. Like you got Bitcoin, you got a Bitcoin spot, you got Bitcoin perpetual, and you got Bitcoin future, and then you got a bunch of different ones as well. And they also tend, of course, they all move as Bitcoin moves. But as we saw yesterday, the basis on the expiring futures can lead its own life in a little bit. Like we even saw backwardation yesterday. You were talking about how even a few days ago it was insane contango, meaning the futures were trading at insane premium compared to spot.
Right.
Yesterday they were trading at a discount on the quarterlies, like, and a massive discount as well. So like that's generally safer because at least you know that at expiry there it's gonna settle into Bitcoin equivalent. But yes, you can do that. But if you look at what we do, like we see a lot of risk in terms of correlation. So it's more what you describe in terms of hedging different stuff, like a Ripple into Bitcoin, for example, or different coins. We see that more as like StatArb, which is more about statistics. It's not really about raw speed. But it's it's a big part of the space. Many people are doing it. There are actually I don't know if you guys know Tribuca from Alameda Research. He tweets a lot, and he has a very, very interesting tweet thread. I'll try to dig it up in a little bit, where they go into how they look at that. But you kind of always have to keep the correlation in mind, basically.
Absolutely. Yeah, it's I'm sure so much more you could share with us on that. Yeah, that's great. For the rapid fire, we are going to keep you to a bit more of a snappier pace here.
Okay.
Let's jump in with the first one. If you had to choose one asset to trade between NFTs or Bitcoin perpetuals, which would it be?
Perps. I don't understand NFTs. I like them. I think it's very interesting space. I think art's super interesting. And I think NFTs is super interesting. I just don't understand it.
Great. Always trade what you understand. Yep. Right. So in one sentence, what do you see that's common between the 2017 and 2021 bull run?
The amount of buying power that there can be. The amount of money that can enter the space. Like right now we're seeing Tether minting of $1 billion a day. It's like $1 billion is entering the Tether kind of, which includes Binance and all the Chinese exchanges because they're all Tether driven, right? So much money is coming in. It's kind of like in 2017, no one was ready. And now it's very clear there's still even opportunity by hand sometimes because there's just, just insane amount of money.
Yeah, no, that's very true. So in your opinion, what is the single biggest use case for crypto, just at large or in the decades to come?
DeFi. It's definitely the trend a little bit right now, but like this is also why I got back into it. So decentralized finance and the innovation you can see there, and we are seeing now from DeFi. I think because of some of the properties of like just, for example, smart contracts on Ethereum, for example, like they're all composable, they can all talk to each other. things are happening that, like, they would never be able to exist in traditional finance. And I think the innovation we potentially can see there can be similar to, like, we saw with like, this is definitely, like, everyone's making this, but, like, no one could really predict what the internet was going to be good for, right? Like, it was going to replace mail or something. It was like, that's a little bit meh. And now we're like, well, we got social media and we got all these things, right? I'm not saying it's going to be as big. I doubt that. I doubt it's going to be that big in terms of, like, like the whole world is going to be trading DeFi. I'm not sure about that, but I do think in terms of, like, we will see innovation that nobody sees coming, and it's going to be massive.
Super.
Yeah, and that's perfect segue into fourth question. Complete the sentence. DeFi makes.
Opportunities more fair.
Good one.
Yeah, I like that. And in some cases, it's like open finance is another interchangeable term, right?
Yeah, exactly. Yeah.
Perfect. All right. And last but not least, what's a piece of advice that you would give to a new trader?
So besides looking at DeFi, I would really, what I really learned, and it took me quite a few years to figure out, is that, like, you can also make money not trading the price. And if you're a new trader and you see that you struggle with like trading the price, like predicting, or not just predicting, but like looking at the chart, spotting a setup, like if you're good at that, keep doing it. It's great. If you're not good at that, like me, at some point, just realize that and focus on other things, because there are many, many ways of making money in crypto that do not rely on predicting where the price will go. So very obvious one is arbing futures versus spot, for example, like the cash and carry trades, stuff like that. And in DeFi, you see it as well. There's a lot of, like, market neutral stuff. That's the first thing. The second thing is, like, think out of the box. And if you think that, well, some things are too obvious, but if you think that something is like, oh, this is too obvious, like, there's a reason why, like, there's a saying in finance, right? Like, there's no such thing as a free lunch.
Mm-hmm.
Like, my last years in HFT, they made it clear that, yes, there is free lunch in crypto. Also, traditional markets, there's loads. If you're smart about it, you know what you're doing. You set up a plan. You try it out small. You scale bigger. You can make a lot of money. Don't be afraid to kind of chase something crazy.
Excellent. Very cool. I think this has been really fun, Mike. I think the entire session and everything that you shared has been awesome. We've really enjoyed it. Hopefully you had fun as well.
I did. I hope I didn't say too many things I shouldn't have said, because this is live, right? It's already out there, contrary to other podcasts that are like, oh, please cut that part out. Can't do that now. So I hope I was fine there. No, but I really enjoyed it. Yeah, thanks for having me.
Yeah, and we're seeing in the chat there as well, people really loved your answers that you gave to those questions. So thank you. It's been really, really good having you on. And yeah, I hope everyone's learned something from today's session. So thanks, Mike.
Thanks for having me. Bye.
Fantastic.
Cool. All right, Shanky, that was, yeah, a lot there. And I'm sure we'll have to get Mike on again sometime in the future to cover some pieces of that in even more detail.
I really liked it. I think, it shows from the way he approached it that he's deep into things, active trader, just been on the journey. And I think the listeners loved it. We loved it. It's like we need more of these guests. I think they're just phenomenal. It's good.
Yeah, and he also had a few links he wanted to share. So yeah, we'll add those to the show notes and also tweet those out. If you're not already following us, please follow us at Going Elliptic on Twitter or goingelliptic.com for our semi-regular newsletter, and we'll be sure to include all the extra content when we send that out.
Absolutely, yeah. I think that we'll definitely share, as you rightly said right now, and perhaps in the newsletters, I must say Mike has also given us some ideas. There are topics that I can see from the questions that people might want to dig deeper into, and it might be things that we might want to cover in future as well.
Yeah, no, definitely. And if there was something on your mind, if you're there in the audience, do drop a comment on the video or reply to one of our tweets with any requests of content you'd like to hear. Because we're very much doing this as educational content for everyone that tunes in. So like, subscribe, and comment.
100%.
Great. Well, I think we'll wrap it up there for this week's conversation. Another one I'm going to replay a few times to kind of digest everything that was there. But yeah, if anyone's there, do tune in next time for next week's Going Elliptic sessions, and we'll be talking with other traders and fund managers and people behind the scenes with what's their journey in crypto.
Yep.
Cool.
Going Elliptic.
See you next week.
See you next week.